Hi, my name is Amber, and I'm a financial education coach with Prosperity Connection. You can think of me as a personal trainer for all your financial goals. You tell me what you're trying to do, and I help you formulate a plan to get there. We do free financial coaching and classes in the St. Louis area, and some of our classes include credit building, budgeting, buying a car or home. I've been asked to talk to you about bills, savings, and goal setting today. All three of these topics depend on your own individual circumstances. So if you have further questions or thoughts after this presentation, give us a call at 314-256-3995 or email us at center@prosperityconnection.org. So let's start with spending. A good rule of thumb is the 50-30-20 rule. This rule talks about 50% of your take-home pay going to essentials, like housing and transportation and utilities, 30% of your take-home pay going to extras like shopping and going out to eat, and then 20% of your take-home pay going towards savings. So if you made $1,000 a paycheck or a couple $1,000s a month, your budget may break down like this. $1,000 going to essential bills, $600 going to fund money, and $400 going into the savings account. Breaking down that essential bill category further might look like $500 in rent, $250 in utilities, and $250 in transportation costs like car payment and insurance. So maybe you're about to go strike out on your own. Maybe you're about ready to go to college or get your first apartment. Your biggest expense is probably going to be the roof over your head and everything that goes with it. Unless you're going to live in a dorm, most places are not all-inclusive. This means even if you can't afford the apartment, make sure you can afford everything else too, like utilities. Some of these utilities might include electricity to power your life, natural gas to heat and cook with, trash removal, water access, and sewer to remove waste. Your new place may have all of these included or none of these included, so make sure to ask questions about the utilities before signing a lease. Questions like what utilities are included and what utilities are my responsibility. What is the monthly average cost of these utilities? If you feel like being out on your own is too expensive, consider getting a roommate to cut your costs in half. So those are bills that have to deal with the home. Let's talk about the extras. And to do that, I'm going to introduce the concept of needs versus wants. You need food. You probably also need some form of transportation. And I would even go so far as to say that you need a cell phone these days. Employers that have to contact you, your family might need to contact you, that's all very reasonable. What I want you to be mindful of is what kind of food are you purchasing? Are you purchasing the $20 pizza delivery or the $5 pizza for the oven? What types of transportation do you want to use? The brand new car with the $400 a month payment, plus $200 in insurance and gas a month, or a used vehicle with the payment half as much? And what about the phone plan? Do you need a premium plan with all the bells and whistles? Or will the standard plan get you where you need to go? Because these are monthly bills, and they come every single month, and I don't want to see you zap away your paycheck before you even get it. Did you know that some companies will even give you a discount if you tell them that their service costs too much? You may not be able to haggle utilities, but you can ask for better rates on car insurance, cable, and cell phone. Because at the end of the day, if you're spending all your money on needs, you don't get to spend any of your money on wants. You know, fun money, shopping money, hanging out with your friends money. So my advice to you is to keep your baseline needs low, so you can have the flexibility to spend your money where you want. And you can afford to save. So if you want that fancy car, go for it. But be aware that you might have to sacrifice something else to get that car. You might even consider getting a notebook, writing down your take-home pay, then writing down what you need to spend your money on until the next time you get paid, your expenses. Do that every paycheck to keep track of your money. It's called a budget, and it's just that simple. There are lots of helpful apps out there. Pick one and try it for a couple months. If you feel more aware of where your money's going, that means the budget is working. Budgeting, just like anything else, takes a bit of practice. So if the first month you miss something, don't be hard on yourself. It's a learning experience. You'll get better as time goes on. And since we're on the topic of budgeting, another thing that you should be accounting for is savings. The first savings account I'd really like you to focus on is your emergency savings. Experts recommend that you have 6 months worth of expenses saved up. And that sounds like a ton of money, but just keep working at it. Savings is built $10 to $20 at a time. And remember, we're talking about emergency expenses. You don't have to save up 6 months worth of paychecks, just 6 months of absolute necessities. So take a minute, write down your bills at any given month, add them up, and multiply by 6. That's your goal. Give yourself time to get there. Maybe it takes a couple years. That's okay. The next type of savings account I'd like to talk to you about is retirement. There are many different types of retirement accounts out there, and they all have their pros and cons. But I want to talk to you about the most popular type of retirement account, and that's called a 401k. 401ks are retirement accounts through an employer that the employer puts a portion of your paycheck away for you before you even get paid. So you never see that money. If you are putting money away in a traditional 401k, it helps lower your tax burden for the year because taxes on 401ks are paid at the time of withdrawing funds. One of the major perks of having a 401k is some employers match the funds. So every time you put money in, they might put some money in as well. That's free money. So the earlier you save for retirement, the better. Growing your money takes time, and compound interest helps. For example, an 18-year-old making $30,000 a year, putting 10% away into their 401k, adjusted for inflation, they could be a millionaire by the time they retire. Diligently putting away money and letting it grow long-term is the key to financial wealth. When you're young, time is on your side. The longer you wait to save, the more money you have to save in order to reach the same goal. Every employer-sponsored 401k is different, so when you have the opportunity to sign up for a 401k, ask your employer about all the different options they have. Lastly, don't forget to save up for fun future things, like vacations and down payments and taxes on a new car. Remember, saving is just about planning and preparing for the future. Everybody's savings is going to look a little different because everyone has different goals. Here's 8 tips to save more money. Start small. If saving money is not something that you're used to, start with small amounts. Try $5 a paycheck and see how long you can keep up that momentum without touching the money. Try to save something every single time you get paid. Building a savings account is a lot like building muscles. You have to regularly go to the gym / make deposits. If you start small and work your way up, you'll get to your goal. Speaking of goals, write down an attainable goal. Only you know your income and bills, so this is personal. Give yourself a period of time and an amount that you want to save. Write down the goal somewhere where you can see it regularly, like on the refrigerator or on the bathroom mirror. Use your banking app for good, not evil. When I was younger, I used to try to save only to transfer my money right back into the checking account. Now I play a game opposite of that. If I see something that I want, I tell myself not today, I will transfer that money into my savings account. And a good example of that is not going to Starbucks. Savings. So savings isn't about taking away money from you. It's about building money for you. This one's all about your state of mind when it comes to saving. Honestly, I can't change your mind or feelings about savings. I will tell you, saving is a lot easier and way more fun when you think about it building your future, not taking away from your present. Dream a little. How much better would you feel if you had money set aside for a rainy day or a job change? Would you feel less stressed? Would you argue a little bit less with a partner? Number 6, auto transfer or not to auto transfer. In theory, auto transfer helps you save by setting it and forgetting it. The problem is What if you forget it and you overdraft your account? If you're going to set up auto transfer, please have a written budget with savings accounted for just like any other bill, because the last thing you want to do is overdraft your account trying to save. Number 7, use savings accounts outside your normal bank or credit union. You want to have access to your savings account without temptation. So keeping money that's earmarked for an emergency separate from your normal debit card or checking account is a safe way to keep that money long term. And lastly, buy some certificates of deposits. What are certificates of deposits, or CDs? They're deposits with a timer and a lock on them, and then you can buy them from most banks and credit unions. The usual limit for a CD is 6 months to 5 years, and the longer you lock away your money, the more interest you get paid. If there's a real emergency, you can break open that CD for a fee, but the fee really encourages you not to take that money out of the account unless it's a necessity. And that brings us to our last topic, goals. Goals are very personal, and they can be used for anything. They can include a personal goal, wanting to be a better friend, a professional goal, wanting to earn a promotion, and an academic goal, I want to graduate from college, a business goal, I want to create more revenue for my company, or a health and fitness goal, like I want to bench press 20 more pounds. They can be short-term, like making an A on a test, or long-term, like saving up that 6-month emergency fund. The trick is you have to find something that you care about. I can't tell you what to make a goal, but I can tell you how to make a goal. And I'll give you a couple of examples using the SMART goals technique. This is a written method that helps you clarify your goal and break it down into smaller parts. SMART stands for specific, measurable, attainable, relevant, and time-bound. So let's use getting an A on the test as an example. Specific. I want to get an A on my biology test. Measurable. I know that it's an A by my score. Attainable. I can get an A if I study the materials and attend my classes. Relevant. This goal is relevant because it helps me continue my education. Time-bound. I have from the time my teacher announces the test to test taking time to accomplish my goal. Let's do another one. How about our 6-month emergency fund? Long-term goal. So specific. I know that in order to have enough money for my emergency, I should save 6 months worth of expenses. My expenses are $1,000 a month, so I need to save $6,000. Measurable. My balance in my savings account is how I plan to measure my goal. Obtainable. This is an obtainable goal because I have a job and I have a surplus of money. Relevant. This is relevant to me because it helps me create financial stability in my life. Time-bound. If I save $50 a paycheck, I should be able to reach my goal of $6,000 in about 5 years. Remember, a goal without a plan is just a dream, so write down those SMART goals. So we have given you an intro today on bills, savings, and goals. There's a lot more to learn and a lot of different things to consider, so if you need additional help, please don't hesitate to reach out to Prosperity Connection. We want to help you reach all of your goals. Thanks.